done multiple videos explaining different strategies to you guys, CRT, CIT, MRT, and even various ICT concepts. However, none of them will ever make sense if you don't understand the actual market design. Most traders don't lose money because they're wrong. They lose money because they don't understand the context of the market. They don't understand why price is moving, and this leads them to taking trades with no real conviction, and it all ends up in a cycle of losses, failure, and regret. And I've spent years doing the exact same thing, switching between strategies, trying to find the best system. However, the key was right in front of me the entire time: the candlesticks and how they interact. And in this video, I'll show you exactly the 3 candlestick combinations I use every single day to get into the best possible trades and identify the right market direction every single time. And then we'll finally go over some real chart examples so you can trade with clarity and confidence without guessing the market anymore. Now, the first thing to understand is the intention of a candlestick. Once you get this, you'll then be able to master the bias and lead yourself to your next desired trades. Now, I also want to understand that every candle tells a specific story, and once you understand that, you will then understand the market and master it like you're just reading a book. So what is a candlestick? A candlestick is a visual representation of a price movement within a specific time period, condensed into a single data set that shows the open, high, low, and close in price. And right over here, these are the only 3 candlesticks simplified to the basic matter that you guys need to focus on: your impulsive candle, your power transfer candle, and lastly, your indecisive candle. The market is between a constant battle of both buyers and sellers. For an example of an impulsive candle, when we are seeing a bullish movement like this, it is directly meaning that there is more buying, which leads to these higher prices, because as you see the market increasing price share, you are triggered to want to get into that movement and follow the crowd and follow the momentum of that candle, which leads to a snowball effect, and we now have this large bodied movement. And the same exact with selling. Lower prices mean people fear the loss of losing their capital, so they lose interest in their asset, dropping its price, dropping its demand, and leading to a large bodied bearish candle. Once again, you need to understand the intention and psychology of the market participants behind those candlesticks to trade them profitably. Now let's go over how a impulsive candle would show its main signature. It firstly starts with a flat line, which we have right here, just condensed movement with no real price displacement. That is the opening of that candle. It then starts moving bearish, which now price is making the extreme low within that time period. We then now finally have our distribution, which leads to this major body, and then lastly coming to the end closing hour of that candlestick, we finally then exhaust and leave wicks on either side. Understanding that the wicks represent the extreme points of that time period of the high and the low. Buyers are simply being prioritized in the market, which gives you bullish incentive. Now let's go over a 1 hour candle. So a hourly candle stems for 60 minutes, which is why that within this, I'm noting down 9 o'clock to 10 o'clock. That is 1 hour of price data. Within that hour, there were multiple variations and fluctuations within price. When the candle opens, we first get that opening consolidation. It's like an engine. It takes its time to start up, but once it finally hits that full trigger, we then now have the full boost, which is that massive distribution. Once you now finally hit the peak of that price displacement, we then finally start to taper off, coming closer to 10 o'clock. As the candle is closing off, we now have the exhaust, which now leads to price closing off and leaving this wick. What I want you to take note of is that from the open to the close, we have a positive gradient, which is why we have a bullish candle. Now, that entire schematic of price slowing down, going lower, then finally having that ignition to push with volatility. It all lies down to your power of 4 or power of 3, which follows the accumulation for the start of the hour where we're consolidating, the manipulation where price now finally makes your major manipulation and liquidation. We then have price create your distribution, which is the massive upthrust of volatility within the hour, usually right in the middle of that, so possibly around 9:30, which you should know that is New York Open, if it's EST. And then lastly, we have the exhaust where price now once again loses that momentum and finally closes off exactly at 10 o'clock. Now, once again, these are little schematics of this. Our bullish candle starts with the open, the low, high, and your close. Understand that it has a bullish movement through the entirety of that candle, which leads to a positive gradient. Now let's go over a bullish impulsive candle. Now this one would specifically start with price opening up that flat line, going bullish first, then distributing bearish, showing you that bearish intention. The sellers are now being prioritized within this market. And then finally, we do get a bit of buying pressure just at the end of the candle, which then leaves the exhaust on the lows. And then finally, we do also have our wick at the highest price that price was able to reach. Sellers are following this bearish incentive. Now, once again, we have our open, our high, low, and close. Very different from how the bullish candle was formed out. But what is similar is that our gradient marks out how the candle will form out. With this being a negative gradient, this leads to this being a bearish candle. Now, it's very important to understand that even though we are constantly impulsing, there will still be pauses in the market. However, remember that the momentum of that impulsiveness does not just stop. It will then continue once price has had its rest period. Now, with that in constitution, the body of that candle does matter. A larger body means more price displacement within the given period of time. Understanding that as these keep on getting bigger and bigger, that is more bullish intention with each candlestick. And even better, it is happening within a specified time range, which leads to more volatility. Now, I want to help you guys understand how to start to use this knowledge of candlesticks into biases and context that you can form out within a market. So we're going to look at this previous candle. It's impulsive, but take close attention to how price reacts at the close. This is a bullish candle, so it opens at the lows, closes at the highs. The next candle also open at that exact same point. Why? Because it's just translating and carrying on the prior movement that happened in our prior session. So with that, our new candle starts off bearish, making the first retracement. And then that leads off a wick. Price then distributes once it's done making that retracement. And then lastly, we have our exhaust, which leads to a nice bullish candle there. Understand that this close to open is the key factor that we can take advantage of and have a repeatable procedure that we can take full use in the market. Now, what I want you then to understand is that you can now extend levels of a certain kind of range. Your 25%, 50%, 75%, and this will mark out what I call your CIT range. Essentially, it's just the high to low, and that shows you your 25, 50, and 75%. With that being said though, your new impulse candle will look to make a very short retracement just to the 25%. If it goes beyond 50%, be very careful. That could be a reverse and you would not want to trade that. Remember, in an impulsive market, you want shorter retracements and longer impulses, as this is how price goes to its objective. This is how price continues its momentum. So this is a very good example of this. Here, this line divides your previous candle and your current candle. So our Tuesday candle, I'm just using the daily time frame for this, just so you guys can get a better perspective of this. This is the 15-minute time frame, so all these lower candlesticks. So as you can see, our daily candle starts off a bit bearish, which is why we have this wick over here. We then start to push aggressively to the upside, which is now where the bullish incentive is being brought in. And lastly, just to the end of the day, you now start to notice that it's end of day, we're losing volatility, which is why we're starting to manipulate and sort of just consolidate a lot more. And that leads to this high side wick, which is your exhaust. And then coming to the next day, tomorrow, we then start again with lower ignition, slow movements in price. That is why we start off with this flat line going up and down the opening, which is the starter line here. We then finally start to manipulate, create the first liquidation of the day, which is a massive bearish candle, and then finally price starts to reverse. What I want you to notice is that this first line is our 25%, this is our 50%, and this is our 75%. And price is only lingering at that 25%, which means we have a short retracement, which means we can continue the impulsiveness to the upside. And that is why we can take on this trade here. Now let's go over our power transfer candles. These candles are known as the rejection that a lot of us have communicated it as. But simply, how does it actually work? It's by price creating an internal reversal by opposing the previous nature. Let's delve into this. So firstly, we make a massive bearish movement at the start of the hour. For a 9 o'clock candle, this is 9 to 10. So maybe around 9:15, we're making this massive bearish movement, but in closer to the end of the candle, so 9:45, 9:50, we make this massive push back up and we leave off this massive wick. So what this initially shows us is that we had bearish intention, very strong bearish intention in the start of the hour, and then coming to the last lingering moments of that candle, we then have a massive surge of bullishness, which is why the rejection is known to be used for this candle, because price simply rejected the bearish nature coming towards the end. And this is why we have our internal reversal. As you can see, this blue area, it represents a POI, so a order block or a fair value gap that price has just reached. It's giving you that immediate reaction, which is why it's also seen as a mean to try and trade a possible reversal. That is the continuity of this. Now, with this, multiple power transfer candles can stack together to create a very strong reversal. As you can see, this wick shows you this perspective that there are stronger reversals happening on the lower time frame, meaning that even though price does want to reach a certain objective, it's getting denied, and that leads to this massive wick that we can also identify as sweeps. Now, the idea of this is to sell once we have a bearish power transfer candle. So like in this example here we have a massive bearish candle with a large wick. With that clear reversal, you should be looking to sell within that market context. And in a bullish example, we have a candle right over here. It creates you a larger wick on the downside. That would be considered for a bullish candle transfer. The context always matters. Now let's go over the liquidity that lies with every single candle. Now it's quite simply to understand that every candle is a range that we have discussed prior in this video. And what's very important to understand, with a range, there are always liquidity at the highs and lows, and we can take advantage of that and trade the reversal as price starts to target these areas of liquidity. So our candle low and our candle high are various points. If price takes out a candle low, its immediate next objective would be the candle high, which is why we can try and trade that reversal. So with this example right here, we have our candlestick, and you can see here is the higher time frame candlestick on the right, and here is the lower time frame movement. This is the 5-minute time frame. This is the 4-hour candle. As you can see, that high and low point is simply areas where people put their stop losses. If you were selling down, you'd place your stop loss at the high, and as well, if you're looking to buy at this fair value gap, you put your stop loss at this low. So there's liquidity lying at those points. It's very important to understand that. So as you can see, as price comes down to make a sweep of the low, it firstly takes out the buyers, and then next it comes to take out the stop losses at the highs. And you're looking to trade this reversal to the upside. And as you can see, our next candle is sweeping the low and then taking out the high. That is why you can never lose with those candles. Now, your power transfer combination does a very similar thing. It takes out the prior candle's high, and then the next candle takes out the prior candle's low point. A bullish to bearish power transfer. Look at this example. Here are our higher time frame candles, the 4-hour time frame. Bullish, bearish, bearish. Sweeps the candle high, wicks above it. As you can see, goes above, shows you bullish intention, and then immediately comes back down to reject that bullish nature. That is the opposing nature. Once again, we are looking at a power transfer. Once you see that, you're then looking to trade that optimal reversal, which is why this FEG was your valid entry point, and you're then targeting the liquidity at the lows. Quite simply, that is how you combine a candlestick to find a bias as well as a trade. Now, your indecisive candles have a very interesting facade. They are a balance between both your buyers and your sellers. And this displays true confusion as no market participant has truly proclaimed priority over the market, neither the buyers or the sellers. That is the true war between them. And within these, it's usually best to just identify them as ranges and use them quite simply, similar to how we're looking at a liquidity at the highs and the lows. Now, let me ask you this. If we see that prices continuing to make these impulsive major body candles, what would you expect the next candle to then produce? And we guys said that the next candle would then be bullish, you would then be correct. You do not want to look to fight against the market momentum. It's showing you that it is pushing up. You're looking to trade that next bullish candle. And how do you do this? You make use of your candle impulse theory simply by trading that prior close to opening. Once price opens up, it goes bearish and you're trading that retracement optimally between the 25 to 50% Fibonacci range. Now, what if price is doing this? What would your next candle look to produce and how would you take advantage of it? Very well done. You then want to look to trade a more so of a CRT because all of these are rejection candles with not a lot of momentum. It's more so indecisive. And within this movement, you're looking to trade a reversal of either end. So as you can see, if price goes above here, you're looking to trade the movement to the downside. Let's go into some practical examples that we took this week that you guys can also use and journal as your data. Examples are all just differentiations of this. This example was sort of a CIT into a CRT because price did sweep the high, then reverse. This one as well, price can see does make this little wick. Zoom this in here. Does make a wick into this area and then goes to the high. Simple liquidity sweep that we've all learned in our basic ICT Academy trading. This sweeps the low first, then goes to the high. You guys should start getting the idea now. Price takes to the high first, then goes to the low once again. And the best thing is that even within a rangy market, which some people might see as low market conditions, you're finding these sniper in and out entry points day in and day out, right? This is Thursday, this is Friday, this is Monday. Day after day, a repeatable process you can expect. Now, there are variations where price doesn't make a sweep and then just continues higher. Now, these days are where we have to adapt and start using our CIT. But as you can see right here, this was another sweep of the high to the lows. This is actually recorded. The exact live stream I will try and post also on YouTube so you guys can see the full introspection. But a lot of the live streams are kept for the Novo Legacy community for their learning purposes. But as you can see, this was just one of the trades that we took with the Novo Legacy, and the live stream should be posted for you guys to view as well. But all the other ones, they are kept for Novo Legacy educational purposes. Okay, if you guys want to access that, you know where to find it. Now, going to this most recent example, simple, repeatable procedure that you've been learning through this entire video. Let's first understand what type of candlestick we have on our high time frame here. So we do have, firstly, a indecisive candle, right? So within this point, it's not like it is not fully confirmed that we can just run to saying that price is gonna go bullish or bearish. Okay, on these type of days, it's a full balance between buyers and sellers, and here we have to be a lot more introspective and look at the lower time frame to confirm this. Now, the simplest thing you can do if you are a bit confused is just mark out that candle's high and low point, which we have done here. This is my prior 5 candle high and low point. And now simply at 9 a.m., I'm waiting to see how price reacts to these lows. So we're going to push up there. So we do get a sweep, right? That's the main thing. We do get a sweep ultimately. And as you can see, we do then reach the opposing side of this range. Okay, but we're going to come back to here when we did get the sweep. Okay. Now at this point, we're going to go to a lower time frame. I preferably like the 2 minute time frame. Oh, and this looks a lot more better. What are we saying? We are looking at our common way that a bullish candle is formed. Firstly, we do have our prior range, which has liquidity on the highs and lows. We just take out liquidity at the lows right now. And where's the next point? The highs. Okay, perfect. We understand that. Now, knowing that we are following this range manipulation thing going on here, we also have to understand that our most recent candle is following how a bullish candle opens and closes. So what does that follow? It follows some procedure of price accumulating, then manipulates, which shows the bearishness, and then it will be followed with a distribution to make that bullishness. Okay. Now, if you guys are still a bit lost, please scroll back to the video. It's really important that you guys do understand this. Okay. Candle mechanics is all you need to fully trace the market and understand it. Okay. So let's just wait for a common reversal trigger. Okay. So yeah. So you get a really nice, okay, we just skipped a bit there. So we do get a pretty nice little bullish intention here. And it's mainly going to be confirmed by this change in state delivery right over here of them. Now I'm going to wait for one more candle just to fully confirm this, because as you can see, I'm looking at this candle. It's about to flip bullish. I want a bit more of that bullish intention to reject. As you can see what's happening, bullishness is now rejecting the bearishness, which is leading to this wick. Okay. Very happy that you guys are following along there. We're going to place our entry up there. Stops right below. Okay. And then we're targeting the most recent high point, which is this liquidity at the highs here. And then where we place our stop loss below our last point, which is going to be this FEG. So pretty standard entry there. So risk 1%, place our TP and our SL. Now I want you to pay close attention to how this candle moves as we play out this trade here. There you go. Starts to go bullish. And what's the commonality? Is price is going bullish as it's going above this opening line. And as you can see there, it does finally have that bullishness and we are out the trade. Simple as that. That is our candle range model. Now let's go over another example where we're not really following a rangy market, but more so a more impulsive market. Once again, you guys want to be very nimble. And that's just another skill I'm trying to lay off to you guys. Now, with this very quick bias here, very simple order block, which was created on USDJPY. And actually look into it. This follows a very interesting kind of combination we've just discussed. It follows a power transfer. CRT went from bullishness to bearishness, and then this order block actually made the major sweep of our prior candle, right? And if we actually come now to our most recent tap of it, it creates yet again that same kind of combination. Once again, this is market procedure. You guys want to get in line and understand this if you want to also fall into the right market direction, okay? Bullish to bearish power transfer, major sweep closes below, and then goes to the low point, okay? Now, first thing already, we can see that we are following a continuative candle layout here. We have impulsive candles followed by indecisive candle, then another impulsive candle. Overall, we see that the impulsive candles are taking priority. So with that, you're going to simply follow that market movement. This is a bearish candle, so here's its open and there is its close. Now, the best part is you just mark out your Fibonacci. Now, I specifically use a GAN box to get these levels. And as you can see here, once again, it is just my basic 0, 25, 15, 75 levels. Now, the goal of the impulsive move is for very short retracement. So we're only looking to at least see the candle reach into this area, which is the 25 to 30%, which is this nice little blue quarter. If it goes in more than that, it's a lot more invalidated. So let us go to the lower time frame here. I got 3 minutes. Now I want you guys to also notice something that, look what's happening. When it's an impulsive candle here, the main thing is it makes a really short retracement, which makes this really short wick at the top. So I'm actually just trying to show this to you guys here. There you go. There was the little retracement that this kind of made. And then it's followed by a massive distribution there. But there you go. Here's where this kind of closes. And then the new candle starts again. Now, as you can see, this kind of does make a little move up into that 25%. Okay. Which is literally this small little wick up. That's all you need. Okay. That's literally all you need, because remember, small wicks, it is a shorter time frame. Okay. So with this, we can go back to our CRT. We know we can go back to our ICT. entry models we would have learned. So a very basic one that is easily identifiable was a turtle soup, which then led to price coming to this prior order block here. And then we just start to scale down lower. So very simple models to enter with the continuation here. And you can see we're getting our entry quite fast into the session, mainly because price is only creating that wick usually within the start of that candle. Now you can see I do place a very conservative stop loss above the 25% in case we do scale up, which is once again a viable option. You want to be prepared for that. And now for my TPs, I'll just scale down and look for a nice little 1 to 2 there. Once again, we can also go a lot more with these because they are continuations. We're going to place our entry there, TP down below here, and then stop loss just above. So now pay attention to this candle. Once again, it's starting off bullish here, bounced off its distribution. So there you go. That one finally does hit TP. I wanted to actually play out the entire thing so you guys could pay attention to how each and every single higher time frame candle relates to a lower time frame movement. Now let's actually try and dissect this. So the entry was a bit premature, but if you just try and mark this out, this would be our accumulation. This massive move is our manipulation right here. And then this entire move down was our distribution. And then price finally closed off with an exhaustion here. Once again, this follows our power of 4: accumulation, manipulation, distribution, and then exhaust. And then we did it again with the next candle. Very similar perspective there. Price starts with this, firstly just manipulating, then distributes, and then does this little funky close to make up the exhaustion here. Let me just try and color code this for you guys. So there you go, nicely color coded. Accumulation blue, manipulation purple, distribution green, and then exhaust is orange. Once again, each and every single candle close relates to a very key manipulation. If price goes higher, makes the wick of that candle. As you can see, this highest point right over here, this highest point right over here does translate to your major candle wick. And that is how you're going to trade a continuation. And yes, it is sometimes a longer trade, but that's the homostasis of trading. Now that you guys understand that, I would recommend you go watch our video on how I use this 1 4-hour candle for exactly what we did here. The 4-hour candle close, my most reliable setup, which is a lot more repeatable. You guys can click the link right on the top there. And once again, you want to book a free call with me to get more clarity on my system. That'll be in the description, as well as my free ebook and my free course for your guys' consumption.